Good morning. Today we are talking all about perspective, some immediate term perspective, along with some long-term perspective on the markets and the headlines. Plus, we'll be talking about the 5 worst purchases that retirees make, according to a most recent survey. You may want to listen to that. Make sure you're not in the category of potentially making one of those poor purchases right out of the gate when you retire. So welcome to the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program, also one of the most listened to programs in Central Florida, because we come to you on a host of stations throughout the Central Florida region. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week. How about starting the year off with a real financial plan for your future? Stands ready this week to help you out do just that. Our team of certified financial fiduciaries at Nelson Financial Planning. Often you'll hear one of them joining us on the program. This week it is just me. We're flying solo. And so we will continue the conversation that we've been having over the past many months, talking about this battle, if you will, between inflation and interest rates. And certainly this past week, pretty good additional round of that battle, right? So we know inflation, very high, it's gotten lower. In order to do that, you raise interest rates, and certainly the Federal Reserve raised those rates at a very fast pace last year. And so when you're looking at some of the data, particularly some of the data that's come out so far in this month of January, inflation starting to show some improvement. In fact, if you kind of dig down into the numbers, if you will, both natural gas and crude oil, the price of a barrel of crude oil, are down over the course of the trailing 12 months. As you might well imagine, well then, yeah, that's going to impact inflation in a positive way in that it brings down inflation, particularly when those numbers or those prices of those commodities are in decline. Clearly, the interest rate increases that happened during the course of last year starting to have an impact. This past week, retail sales, I think that number came out on Wednesday of this past week, showed a decrease of 1.1% for the month of December. Also, and this was Friday's headlines, Google, for example, announcing its largest layoffs in its history as a firm. A lot of companies, Facebook, for example, as well, particularly on this technology side of things, have been announcing some layoffs of late, certainly as their models have changed pretty dramatically with higher interest rates. So clearly, when we start to see a decrease in retail sales, when we start to see headlines about layoffs, then those are the kinds of things that, higher interest rates are certainly having an impact throughout the economy. And the bottom line is that many of those rate increases, because those rate increases typically take 6 to 9 months before they'll make their way into the economy, haven't really shown up yet. So that would certainly highlight what we think is the course of action that the Federal Reserve needs to do at this point, which is that maybe we just pause. Maybe we just wait and see the work that we have done to date, what the impact is going to be on that. And that's certainly important. I think that's one of the things that the market, particularly this past week, was sort of struggling with, because the Federal Reserve hasn't come out and said it's going to stop. They've come out and said that they're going to slow. But if they slow and start raising rates at a quarter of a point versus a half or 3/4 of a point, which they were doing last year, is that still going to be a little bit of an overkill on those rate increases? And that's why in our letter that we send out every January to our clients, kind of recapping the prior year and talking about the year ahead. We do see, and certainly as we did on the program where we did our feelers forecast at the beginning of the year, the first part it continues to have some volatility, and a lot of the issues that were around in 2022 certainly are carrying forward into 2023. So you would expect that sort of same level of volatility in the markets as a whole to sort of continue in these first few months. But then we see, as we look ahead to the back half of the year, certainly these interest rate hikes should be done by then. And so you would start to see better market conditions at that point. So tough week in the markets, obviously, this past week. Certainly when we think about what the road ahead might look like, there's always volatility. But we wanted on the program today to give you some perspective. And we'll start with some perspective that looks at some recent data in the more immediate term, frankly, earlier this month in January, and then give you some longer term data to just consider. Because when we talk about market volatility in the short term, it is just that. Remember, when you think about investing, when you think about saving money for retirement, and when you think about spending money in retirement, those are long periods of time over which those happen. So it doesn't all happen in a year, doesn't all happen in a quarter. Typically retirement, 30 odd years. Typically the accumulation phase is 30 odd years. So that's a long period of time. And I think sometimes folks just get very distracted. So we thought we would start with a more immediate term piece of data and then shift to some sort of longer term perspective, if you will. So here's the immediate term data. The immediate term data, if you look at the first 5 months of the calendar year, first 5 trading days of the calendar year, and obviously this year, they were in fact positive. And here's why that makes a difference. Here's the stat, and we're going to read it to you. The S&P 500's 1.37% gain in the first 5 trading days of this year was more than double the historical average of 0.58 in years when the S&P rallied more than 1% in the first 5 trading days of the year. So first of all, the first 5 days, a lot better than the typical first 5 days of the year. But in particular, when those first 5 days produce a result that is at least 1% improvement or more, in the first 5 days of this year, we're actually a 1.37% gain. In those years, the average rest of the year gain was 13.9%, with positive returns resulting of 80% of the time. In all other years, when the median rest of year gain, in all other years, the median rest of year gain is like 5.6%. So the first 5 days, and again, it's one of those indicators that we like to look at, we like to think about, but at the end of the day, it is impossible to have anything that gauges exactly what the future may hold. But the reality is, when you see the first 5 days of January of any year being positive, and particularly more than 1%, you got a pretty good track record that the rest of the year is going to be pretty decent. Time will tell on that. We wanted to give you that little bit of statistic in the more immediate term to help bring perspective. When we come back from the break, we're going to have some longer term perspective to share with you here on the program. This is Dollars and Cents with Joel Garris of Nelson Financial Planning. On the program, we're providing some longer-term perspective. Always good when the markets are volatile during periods of time where you see big increases in interest rates, where you see inflation like the current environment. Important to kind of step back and say, okay, well, what's the longer-term perspective on this? And that's certainly what we're going to do in this segment of the program here on Dollars and Cents. So welcome on into the program. We're one of Central Florida's longest-running radio programs, also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So if you want to hear the program not on a Sunday morning or at your leisure, you can always subscribe to us on one of our many podcast platforms. Go to the one that's you're most familiar with, whether it's iTunes or Spotify or whatever the case may be. you can certainly find our channel there at Nelson Financial Planning, Dollars and Cents with Joel Garris. Any trouble locating us, go to our website, Nelson Financial Planning, and you will see in the upper right-hand corner a bunch of different icons. Click on the one that looks most familiar to you, and voila, you'll get automatically connected to our channel on your podcast platform that you like. Make sure you subscribe to us. That way you know when we upload new information or new material, you'll get an alert. That's how it works. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of folks that stand ready this week to help you change your life with a successful and cost-effective financial plan. They also all happen to be certified financial fiduciaries as well. So here's the numbers, if you will. So some interesting numbers to think about. If you look at the markets and where they were on January the 1st of 1993. So that'd be 30 years ago. The Dow opened that year, 1993, at about 3,300. The S&P 500 was 435, and the NASDAQ was 675. Fast forward 30 years, and you've got a Dow that closed the year, last year, at 33,000 and change. The S&P 500 was over 3,800, and the NASDAQ was about 10,500. Now that is the numbers after a relatively bad year where the NASDAQ, for example, went down almost a third. The S&P 500 went down 20%, and the Dow went down 9%. And so at the heels of that bad year, if you look at where those numbers compare to where they were 30 years ago, what you will find is even at the end of that really bad year, the Dow had increased by 10-fold. The S&P 500 had increased by 9-fold. The NASDAQ had increased by 15-fold. Stop and listen and hear those numbers. Dow had increased by 10-fold, S&P 500 by 9-fold, NASDAQ by 15-fold over that 30-year period of time. And that's coming at the heels of where all three of them lost a pretty significant amount during the course of 2022. Along the way, let's not forget the headlines. And the headlines are always the reasons that people look at and say, I'm not going to invest. I don't want to invest, or I want to sell everything. And the headlines are what drives it. But folks, the headlines are always here. If you look at the slew of headlines that have happened since 1993, over that same 30-year period of time where the market averages typically increased by over 10-fold, 1993, you would have experienced the bombing of the World Trade Center, the first time that happened. In 1994, Orange County, California filed for bankruptcy. Remember that? Some of these counties might be filing for bankruptcy pretty soon, going forward, as all of the tax base is leaving some of these states. But 1995, the Oklahoma City bombing. 1996, there was a budget crisis. It's sort of always a budget crisis in D.C. these days. 1997, avian bird flu. 98, there was a Russian financial crisis. Probably going to be another one of those soon enough because I think they're getting pretty cut off from the rest of the world. 1999, it was Y2K, right? Everything was going to just fall out of the sky there. 2000, bursting of the dot-com bubble. 2001, 9/11, right? 2002, it was WorldCom, Enron, all the collapses of those companies because of bad accounting. 2003, we were in Iraq. 2004, continuation of the war on terror. 2005, Hurricane Katrina. And by the way, we're only like halfway through this 30-year period of time where the market's increased by 10-fold. Every one of these years has a slew of headlines. We're just hitting sort of the main ones off the top of our head. Well, not completely off the top of our head. I do have a list here in front of me. I did do some homework. Anyway, the reality is that there's always headlines. There's always distractions. And the reality is that they cause people to make bad decisions with their money And they forget the fact that, folks, this is a marathon, not a sprint. Whether it's saving for the future or whether it's spending those dollars in retirement, that's not an instantaneous process by any stretch of the imagination. We'll continue. 2006, home prices were sky high. 2007, they all fell back down to life. 2008, the great financial crisis, if you will, followed by 2009, where the market hit a low in March of that year. 2010, poverty rates hit an all-time high. 2011, there was an earthquake and a tsunami in Japan that messed up that nuclear power plant. Hurricane Sandy and the fiscal cliff in 2012. 2013, there was a U.S. government shutdown. See, you can't make this up. Like a lot of these headlines that I've just rattled off that were the main headlines in the particular years going back 30 years, it's kind of aren't we talking about still the same kind of thing? There's always these reasons. There's always these distractions that command our attention but need to be held in perspective. 2014, oil prices went down dramatically. 15, there was an economic slowdown in China. 16, it was Brexit. And then a presidential election. Those come around every 4 years. Don't forget about that. 2017, a bunch of political nonsense. 18 was a trade war with China. 19 was an impeachment. 20, COVID, right? And another midterm election. 21 was supply chain, and then last year, inflation. And there was a slew of other headlines that happened in every single year just like that. And a lot of similarities if you think about all of those main events, right? You had terrorism, you had international relations, you had government issues, you had political issues. All of those issues are all percolating in the background. The reality is that there's always reasons to not invest. But if you understand when it comes to how you save your money and how you spend your money, it's not all at once. You're going to spend 30 to 40 years of your life accumulating your savings during your working years. And then, good Lord willing, maybe another 30, 40 years, maybe 20, 30 in retirement, spending those dollars, using those dollars. And that, folks, that's a really long time. So don't get too caught up in today's headlines, whatever they may be. We often talk about them on this program and make that a part of the conversation of, oh, here's what happened last week, here's what happened last month, here's what happened last year. But the reality is, let's not also forget that long-term perspective. The headlines have always been the headlines. They're always there no matter what. Oftentimes the headlines kind of may not be exactly the same, but they kind of rhyme from one year to the next. The reality is, far too often people use them as excuses when it comes to saving and investing and planning. Don't make that same mistake this year. The headlines are always going to be the headlines. The reality is that the journey is a marathon. It's not a sprint. Keep that in mind and keep that perspective on it. With that, we'll take a break. This is Dollars and Cents with Joel Garris of Nelson Financial Planning. So in other news, we thought we would share with you a little bit of the information that we shared with our clients this past week on our beginning of the year educational dinner session that we do for clients of the firm at Nelson Financial Planning. As you know, if you are a client, we hold these events every quarter, and they involve bringing in speakers and experts and tax experts and economists and investment professionals, and it just varies depending upon who is the speaker for that particular session. But we do these every quarter as full dinner educational discussions. And so this past week, we had our kickoff one, if you will, for the year 2023. And so we thought we would spend a little bit of time on the program sort of sharing with you what that discussion was all about, because many of the folks in attendance thought it was interesting, and so we thought we would share some of the highlights on that here on the program, the Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name, of course, Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. Make sure you check out our website, nelsonfinancialplanning.com. Upper right-hand corner, click on any of those links, and you will get directly connected to one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out and subscribe on your favorite podcast platform of choice. So one of the things that became very evident during the course of last year is growth companies, technology companies really found that their path or their profit model was getting disrupted as a result of rising interest rates, as a result of lessening consumer demand. And so we've talked about on the program before of value or dividend-paying companies really making a pretty dramatic comeback. There was probably the biggest spread, if you will, between value and growth last year, with that sort of value being on top of that spread, than we've seen in probably 10, maybe even 15 plus years. As technology has grown exponentially, so too has it become a bigger and bigger part of the investment landscape. But before you kind of steer away from growth just because of what happened last year, and jump wholeheartedly into value, not that you shouldn't have a nice portion of that in any portfolio, but the point of this segment is to encourage folks to not abandon that more growth side of the equation, because we've got some interesting statistics to share with you. Clearly the pandemic, and this is one of the things I think at why that spread between growth and value was so much in favor of value last year, beyond the interest rates and consumer demand. We forget that the pandemic in 2020, 2021 really pulled forward demand, really sort of accelerated. I mean, we all knew that the transition of cloud computing and buying things online and all of that, those were all trends that were very much happening during the course of the years prior to the pandemic. But the pandemic really drove those forward, sort of pulled that demand or that future progress and really compressed it down into a much shorter period of time. Think of how it impacted how we work, right? Whether it's the need for Wi-Fi, whether it's the need for cloud computing and cybersecurity, all of those became a much greater need as more and more of the population needed those particular services in order to continue to work. Same thing for consumption, right? E-commerce obviously increased dramatically. Food delivery, things like that also increased dramatically. Banking, right? A lot of the banks were closed, so you wound up, okay, fine, I'll do the mobile banking app. And now everything is done on the phone. I know that's the case for me. I used to go into the banks and cash the checks. Not so much anymore, because then the banks weren't really open during COVID. And then it's like, okay, well, fine, I'll go online. I'll do the banking app on my phone. And now I haven't walked into a bank in a couple of years. That is a massive change that ultimately has pulled forward what was probably going to happen in the future, all in a very, very short period of time. And you see it on the leisure side as well, right? Whether that's all this gaming stuff, like more people watch esports than like the Super Bowl. I mean, the numbers are incredible when you start to look at all these streaming services, things like that, and telemed, things like where you would go see your doctor on your phone kind of thing. So all of that was happening during 2020, 2021. 2022, obviously, kind of was okay, well, wait a minute, this pace of growth is not going to continue like it has been for the past couple of years, because it really is sort of stealing demand from the future. But I think the important part, and this was sort of the gist of the conversation that we had on Thursday in our client educational dinner session, is that there's still a tremendous amount of areas of significant growth. And we'll hit on just three of them that we talked extensively about on Thursday. And first, it has to be this cloud computing stuff. And what that means is you're able to sit with your laptop and basically get data that would typically be at your desktop, at the office, anywhere in the world. In terms of penetration, in terms of usage, in 2020, the usage was about 13% sort of penetration at the start of the pandemic. Next year, that is expected to double to 24%. That introduces huge needs for things like semiconductors, for things like data centers, things like that ultimately store that information, things like cybersecurity. Because if you're accessing that information, you certainly want to be able to access it in a secure manner. So all of that really does drive a lot of what is going on the cloud computing side of things. And so tremendous growth potential ahead on that as well. Similarly with e-commerce, we've certainly talked about this before, steadily growing, obviously accelerated in 2020 and 2021. But in 2021, e-commerce sales were still only like less than 20% of total retail sales. So still a lot of growth still to go there between 2020 and 2021. As you might well imagine, during the course of the pandemic, a 39% increase in e-commerce. Similarly, when we look at some of the gaming stuff, and I know this one I have trouble with. I don't know if you have trouble with this one as well, but I don't understand the notion of sitting on my sofa watching other people play video games. Just the whole thing, when you think about it conceptually, doesn't that just kind of leave you scratching your head? But I assure you that there is a tremendous amount of people under the age of 30 that do a ton of that. That market, in fact, is larger than the global TV advertising market, and it's larger than the global digital advertising market. So clearly, tremendous amount of growth opportunities on there. And then lastly, I would throw in, let's not forget about healthcare, right? The digitization of that, from your medical records to the devices that it implanted that track things on a daily basis, whether that's sugar levels or whether that's heart pace. All of that is just a tremendous growth opportunity for those more technologically oriented types of companies, toss in pharmaceuticals as well. So bottom line, it was pretty interesting stuff that we were able to kind of discuss and give some perspective on. Had a great Q&A session with our clients at the end of it. Some really great questions about different technologies and what we may see for the future. Bottom line, I would still say that there's a tremendous potential for growth. And again, I guess this goes back to what we were talking about in the prior segment, to take a step back and understand that longer term perspective, right? I mean, the cell phone was not in our pocket 15 years ago. Shoot, I don't even think it was in my pocket 10 years ago. The reality is that there's tremendous growth opportunity. So it's still important to be diversified, to be balanced, to make sure that you're owning not just value, because that's certainly very good to own, but make sure you're not reducing down that growth side too much in today's world as well, because there's still some tremendous opportunities out there. We're going to take a break and return after these messages on Dollars and Cents. Recent survey revealed the top 5 worst purchases that retirees make. We thought it would be a good idea to share those with you on the program today to make sure you might avoid some of these purchasing pitfalls in retirement, or at least be aware that there are potential dangers in purchasing these kinds of things, whether it be unexpected costs or whether it just simply might be, we don't use that nearly as much as we thought we were going to. So welcome to the program. This, of course, is Dollars and Cents. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. Make sure you check us out on our website, nelsonfinancialplanning.com. In particular, upper right-hand corner, bunch of icons. Click on that, and you'll get connected to our podcast platforms along with our YouTube channel as well. Make sure you subscribe once you're there so you don't have any trouble finding us in the future. Plus, you'll get notified whenever we upload new content to those platforms. So, as a retiree, certainly important to be smart with your money. I guess that's probably true no matter whether you're a retiree or not. Particularly in today's world with inflation being what it is. But oftentimes, as human beings, we spend money without thinking and end up with buyer's remorse. And what's even worse than buyer's remorse is buyer's remorse with a stream of payments that you have to make every month, reminding you of the bad decision that you made with your money. So we thought we would share these. These come as a result of a recent survey of retirees conducted nationwide of some of the things that folks did that ultimately led to some regret. I think if you stop for a second and think, you'll probably be able to identify a bunch of these, right? First and foremost is that dream car purchase. This is something that typically people have on their mind for years. One of those bucket list items, a memory from childhood of a car that they always wanted. The problem is it comes with ongoing costs. It comes with maintenance. It comes with repair. It comes with gas. It comes with insurance. It comes with all of those, and those costs add up, particularly if maybe it was a classic car, an older car, or something very expensive that you wanted as a symbol of, hey, I've made it, I'm retiring, and I'm going out and getting a Mercedes. Well, okay. There you go. That hits the list of regrets. Combined with the fact that here's the thing that I guess folks don't necessarily realize is that when we think about large ticket items, whether it be cars or houses or whatever the case may be, if you're using retirement funds for those, well, that's all taxable. And that ultimately raises the cost of that item by typically 20 to 30%. So to go and try and spend a bunch of those retirement dollars, what people sort of forget is that it's going to come with a much higher cost when it comes to spending your retirement dollars on a lump sum basis to buy a dream car, if you will. Second, up on the list of the top 5 worst purchases that retirees make, this one's easy. Timeshares, right? Generally a bad idea, no matter how old you are. You don't have to be a retiree to do that. Because here's the problem. The fine print, right? The future liabilities, the ongoing payments, the inability to control it, and certainly the inability to easily sell it are typical characteristics of most timeshares. And so that's why it makes this list of some of the biggest purchasing regrets that retirees have. Bottom line, just take a vacation. Don't worry about trying to avoid that ongoing cost on a regular basis. So timeshares number 2 on the list. Number 3 is, I guess, similar to that dream car, is that dream house, and we're also going to kind of lump of moving as well into that conversation. Oftentimes people say, oh, I'm going to leave the area because it's gotten too crowded. Well, where have I heard that before? Oh, yeah, right here in Central Florida all the time. I'm going to leave the area and I'm going to move to a remote area. The problem is that your entire network of friends and family probably isn't going to move with you. And so you do that, and then you're there for a bit, and then you say, oh, wait a minute, I really miss the structure, the social interaction that I had. And so then you try and reverse that, and then that winds up being a pretty costly expense. Similarly, on that big house, right? Okay, I want to upsize my house, or I want to move to the beach, or I want to move to the lake, or whatever the case may be. All of that costs money, and it costs large chunks of money. Remember what we said about the dream car purchase? If you're using retirement dollars, it's going to cost an extra 20 or 30% because you got to pay taxes on all of that. And when you're using it in a lump sum, what happens is it pushes you up into the next tax bracket. So the reality is grass may not be greener in a different location. Certainly going to have to find a new friend network and all of those kinds of things. And then if you're looking for a bigger house or a house on the water or whatever the case may be, and you've got the cost to upkeep, the maintenance, the insurance, all of that winds up being much more expensive. Plus, don't forget the real estate taxes as well. So that's number 3, that bigger house, and we would toss in making a move as well into that. Number 4, hey, this is true of any age. It's not just a retiree thing. A boat. If you've ever owned a boat, you know that they are expensive, right? Boat stands for bring on another 1,000. That's what it stands for. That's an abbreviation of what it is. If you've ever owned a boat, you know exactly what I am talking about. They're a lot of fun. The recommendation, find friends that have one, and you stay clear of that. Certainly that was number 4 on the list of the biggest regrets that retirees have with your money. Now, that doesn't mean that you shouldn't have a boat. Just be aware, and all of that. This isn't a conversation about you shouldn't get that dream car, or you shouldn't buy that second home, or you shouldn't, look to enjoy vacation. Not at all. Just be aware that there are a lot of hidden issues in these items, which is why they make the list. So make sure, bottom line, that you're doing your due diligence, that you're really stopping and saying, okay, how much is this really going to cost me? Because at the end of the day, I need to know that it's more than just this fairy tale dream, that this stuff costs money. And when I'm getting things, whether it be a boat, throw in an RV for that matter, sometimes we don't use those as much as we think that we were going to. And the reality is that they are expensive, and they have expensive ongoing costs, whether it's repairs or maintenance or insurance or storage or dock fees or whatever the case may be. All of that costs money. So that is certainly important. Lastly, impulse purchases on TV, sort of a need it now mentality. You see the ad on TV and you ultimately wind up buying. Not to say that that's bad, but just understand it comes with a lot of hidden costs. So anyway, that's about it for this week's episode of Dollars and Cents with Joel Garris of Nelson Financial Planning. If you like what you heard, make sure you check out our website, nelsonfinancialplanning.com, or give the office a call this week at 407-629-6477. Enjoy the rest of your day.